Today is Tuesday, October 28th. This is the first day of the FOMC meeting. It's a two-day meeting. Federal Reserve is meeting today, Tuesday, the 28th, and then tomorrow, October 29th. And on the 29th of October, it is predicted, it's almost certain, high probability that the Federal Reserve at their press conference at 2:30 p.m. will announce that they are cutting interest rates again by a quarter point. So I thought it would be a good opportunity to look at what have rates done so far since they last met, and what are some predictions on rates moving forward as we go into November and December. Looking at the 10-year Treasury, as we've talked about, the 10-year Treasury really is the guiding force for residential mortgage rates. And if you look at the last month, we'll scan out a little bit more. The last meeting, right, we talked about this was September 16th when the Federal Reserve met and cut. And at that time, prior to that meeting, the 10-year Treasury was falling, touched 4%. They announced the cut, the press conference, and then it rose back up. Again, another indication that just because the Fed is cutting doesn't mean that mortgage rates are going to come down. In fact, they rose a little bit. But thankfully, since then, the 10-year Treasury now has fallen, and currently, as of today, is below 4%. This is a big breakthrough on the 10-year Treasury. And consequently, what we've seen corresponding in residential mortgage rates is today at Trusco, 30-year fixed, mortgage rates are at 5.75% with no points on a 30-year fixed. At Broadview, on a 30-year fixed, they're at 5.875. On a 15-year, you can get 5.25% for mortgage rates. And then Broadview also has these adjustable rate loans. We still haven't seen a breakthrough below 5%, but you can get adjustable rate mortgage fixed for 5 years at 5%. After those 5 years, it adjusts every 6 months. That's what this 6 is, signifying that it will adjust every 6 months after that 5 years. But between now and those 5 years, you have the opportunity to refinance. Adjustable rate loans can be a smart move if you are not going to be in the house for an extended period of time. Maybe you're going to be there for 5 years or less, or you believe that rates will come down significantly or more than just, say, a half a point over the next 5 years. If that's the case, then securing an adjustable rate loan and refinancing during that 5 or 7 year period makes sense. This is a 5 year arm. This is a 7 year arm fixed for 7 years. And then this is fixed for 10 years. 10 year arm doesn't really make a lot of sense given that the 30-year fixed is at 5.875. So that's what's happened with mortgage rates. And what's more interesting, and I think what's worth highlighting, is that the direction of mortgage rates are tied, as we've talked about, directly to the 10-year Treasury, but they are less correlated to what's happening with the Federal Reserve's interest rates, and can even be more correlated to what's happening with the Federal Reserve's balance sheet or portfolio. This is getting a little bit more into the weeds, but there's some news that Nick Timmeros from the Wall Street Journal broke this morning in anticipation of what's going to be announced at the meeting, that talks about how the Federal Reserve is managing their mortgage-backed securities. And I found this article from PIMCO that highlights this a little bit more. And again, as we've talked about, the 10-year Treasury yield is more important benchmark for mortgage rates, and that's set by the bond market. But what's more importantly is this was an article that PIMCO had published on the 12th of September, and they were making the argument that if ultimately we want to bring residential mortgage rates down, there might be a more powerful tool that the Federal Reserve has besides just cutting their interest rates. And this is their suggestion here, where they highlight, they say, what if the Fed simply stops shrinking its mortgage-backed securities holdings balance sheet portfolio, which is what Nick Timmeros was talking about. Reinventing the roughly 18 billion in current monthly roll-off into new mortgage securities could compress mortgage spreads by 20 to 30 basis points. So that's about 0.2 to 0.3% in mortgage rates. And they go on to say that this compression in mortgage rates, so let's say roughly a quarter point, could be accomplished if they stopped, if they began or stopped shrinking their mortgage-backed securities. And they equate the movement in interest rates, this 20 to 30 basis point movement, as the equivalent to basically a 100 basis point cut in the federal funds rate, or 1.00 cut in Fed's fund rate. Just as an example, they're probably going to be cutting a quarter point, so that would be 4 quarter point cuts would be the equivalent of stopping the shrinking of mortgage-backed securities. Well, guess what? This was published in September, and now, as we learned this morning, it appears as if the Federal Reserve is going to announce at their meeting that they are indeed stopping the shrinking of their balance sheet, which will help bring down mortgage rates even further. So, what do we think is going to happen tomorrow? Don't know. It sounds like the news is already baked in. I guess my hope is, unlike the prior Federal Reserve meetings, my hope is maybe rates don't spike back up. If they do, I think odds are that it will just be momentary and rates will continue to fall as we head into the new year. The one caveat is if we have hotter than expected inflation numbers, and we know some of these inflation numbers have been delayed, this could add to or push mortgage rates, to push the 10-year Treasury, and then therefore the mortgage rates back up. Hope this helps, and we'll find out tomorrow and over the coming weeks how it all plays out.